Hey everyone, it's Christy here from Our Lords Accountants, and we're here today with some last-minute individual tax planning tips. So the current financial year is almost at an end, but there may be a few strategies left that you can put into play to ensure you're not paying any more tax than necessary. Of course, the best tax tactics are adopted in July, not June. That's my not so subtle hint that these are the kinds of things that you should be thinking about as early as possible in any financial year, not right at the end of it. It's also worth remembering that proper tax planning is a lot more than just finding bigger and better deductions at the last moment. Ideally, you'll be working closely with your accountant throughout the year to set your tax affairs in better order for future income years. Not all of today's suggestions are going to be suitable for your circumstances, but as a list of possibilities, they may just get you thinking along the right track. Let's take a look. Now, when it comes to investment properties, many of the expenses stemming from owning a rental are claimable, so it can be helpful to bring forward any expenses before June 30 and claim them in the present financial year. So if you know that an investment property of yours needs some repairs or might require some attention, perhaps some pest control or something of that nature, see if you can have these deductible payments fall into the 2012-13 year. In a similar vein, you might want to see if you can negotiate with the finance provider you use to fund your investment property or margin loan on shares or other loans to pay interest on borrowings up front, thereby giving you a deduction this year. Now, most taxpayers can claim a deduction for up to 12 months ahead. Just make sure that you're actually aware of what's deductible here. So if you've actually redrawn funds from this loan account and spent it on other purposes, maybe a new car or a jet ski or something like that, obviously you're going to have to apportion interest in that case. So every year you'll hear end of year tips telling you to bring forward any other deductions like the interest payments that we just mentioned before. Now, this is particularly true if you know that next year you're going to be earning less. For instance, if you're going on maternity leave or perhaps your work has been cut back just to part-time hours. In that case, deductible expenses that can be brought forward into the present year are going to provide more financial benefit to you. The exception to this, though, is when you actually expect to earn quite a bit more next year. In that case, it's usually to your advantage to delay any tax-deductible payments until next financial year when the benefit of deductions could be a lot more. And certainly it's worth considering using the capital gains tax rules to your advantage. So if you've made and crystallised any capital gain from your investments this financial year, which of course will be added to your assessable income, you might want to think about selling any investments on which you made a loss before June 30. Doing this means that the gains you made on your successful investments can be offset against the losses from your less successful ones, reducing your overall taxable income. Keep in mind, though, that for capital gains tax purposes, a capital gain generally occurs on the date you sign a contract and not when you settle on a property purchased. So when you're making a large capital gain towards the end of an income year, knowing which financial year the gain will be attributed to is really important. Of course, you want to tread carefully and never ever let mere tax drive your investment decisions. Now, if you need to have your teeth fixed or a new set of glasses and you can get an appointment before the end of the year, you might want to consider having some of these possibly expensive medical things completed before June 30, and that way you have that expense to put towards qualifying for the medical expenses offset. Now, the offset is means tested, but if you qualify, many medical expenses are included, like dental and optical. Now, in the latest federal budget, the government has proposed that this measure will be phased out, possibly from as early as July 2014, depending on circumstances. So you'll want to bear this in mind if you are considering expensive medical or dental procedures. There's been an awful lot of changes to this offset starting from this year, and so I'll actually do my next webcast just on medical expense tax offset and changes to that and the medical health rebates. And still claim up to $300 worth of work-related expenses without receipts, providing of course that the claims are actually for genuine outgoings related to earning assessable income. Now, nobody knows their affairs better than yourself, so you're going to recognise whether any of these tips are going to apply to your circumstances. On the other hand, nobody is better informed as to what is appropriate or indeed allowable than your tax agent. And don't forget that any tax agent fee is an allowable deduction in the year that it is paid. Now, every individual taxpayer is required to lodge their return before October 31st, but if you do use the services of a tax professional, you're usually given a lot more time to lodge, which can be a handy extension if you have a payment deadline. Of course, if you're expecting a tax refund, there's no point delaying. In these cases, you really want to get in quick as soon as you can after July 1. Why not? That's it from me today. If there's anything else that you'd like to know about in the lead up to the end of the financial year, just let me know in the comments section and we'll see if we can put some information together for you.